We're on your side tonight with the Halloween effect. It's not about candy or costumes. It's actually about your money. The theory is that stocks perform better on Halloween through the spring. It's a sign you should be investing. So what should we expect this fall? I asked finance expert Mark Henry.
I got to be honest with you, I had never heard of this, at least put in this way. The Halloween effect. What in the world is that?
Yeah, so we're not talking actually about Halloween. We're talking about the month of October when it comes to investments in the stock market. So interestingly enough, two of our worst months of the big disasters, market falloffs, happened in October. But historically, October is the fourth best month of the year, and it actually starts a little run from October to May is typically one of the best seasons in investments.
So let's talk about some strategies here and what investors should be doing with their money when the seasons change. Number one on your list here is assess your risk.
This should be something that everyone is looking at regardless of your age. We see sometimes young people being too conservative. They need to look at that and they're missing opportunities. Or we also see people as they start to age continuing on with what they might have done in their 40s and now they're doing it in their 50s or 60s. Address your risk and make sure you're set up correctly. And remember, rebalancing is your friend. It's very important. The stuff that you had 2 years ago, 4 years ago, in this new world we live in may not be the actual stocks and stuff that you need to be in today.
A lot going on, no question. Educate yourself is number two here.
Yeah, now this is a big one. This is one of the things we talk about a lot. We see people come in and they don't really understand why their portfolio has been set up the way it's set up. And it's your money. You don't have to become an analyst or an advisor, but you do need to have goals-based planning like we do at Alloy Wealth, where you understand why your portfolio is set up. What are the expectations? Is the expectation a high return, or is the expectation a low loss, or a balance of the two? What are the expectations so you can actually understand if you're hitting and achieving the goals you've set out in that portfolio?
Come in with some questions, I imagine, too.
Right.
Right. Yeah. And figure out what exactly is going on. Understand what you can control. What do you mean by that?
Well, this is a real big one. So we know, at least I understand, and my advisory team here at Alloy Wealth know we can't control the markets. We don't have a crystal ball. So we don't try to time markets in and out and things like that. But what we can control is how your portfolio is set up. So what I mean by this is this. You should definitely understand the amount of risk you're taking and what that means in terms of dollars. Your portfolio should never be allowed to fall more than you can withstand. If it catches you by surprise, shame on you, because it shouldn't have been a surprise. You should know that you have a portfolio that could drop 20, 30, 40% if that's the aggressiveness that you want to take, and be okay with that. Because if you're not okay with it, you have to fix it before the event happens. You can't wait till you're in a storm, Jamie, to go find shelter. You're already wet.
Great advice and a great reminder. Important information as always. Mark Henry from Alloy Wealth Management. Mark, be well. Thanks for the time.
Thank you so much, sir.